Hello, hello, hello. What's going on, everybody? How are you guys doing this morning, afternoon, night, depending where you are in the world? Welcome to a capital hungry top-down analysis on the pair GBPUSD. I'm just checking out the YouTube stream here, making sure all the audio and visual is good. So, through this webinar, I'm going to be giving you all a full breakdown of GBPUSD, a little bit of historical analysis and understanding the events that have brought us here to where we are now, understanding some overall market structure, buyers versus seller order flow, some key fundamental catalysts, and overall key fundamental information like market correlations and why those correlations are valid, as well as projections of what's to come in the next couple of days and weeks when we're looking at GBPUSD overall. So let's hop right into it. Some of the things we're going to be discussing as we're breaking this pair down is first going from the higher time frames and talking about some macro fundamental and technical analysis as we go down to the lower time frames, talking about what happened and why it happened. Okay, so let's break down some very, very key events and some very, very similar market repetition in market structure. Okay, now you can see during the 2007-2008 period, when we had the global financial crisis take place, from at that time, very historical high price points where the British pound was almost double the US dollar, glory days for the UK during this period in time, before all the noise from Brexit and before the global financial crisis actually took place. But the fundamental catalyst that led to this downside move from the 2008 period was the global financial crisis. Okay, so what this did was you had a fundamental catalyst come in that led to an information advantage and shift in order flow. You had your basket of risk currencies weaken, your GBP, Euro, NZD, AUD, CAD, and so forth. US dollar still retained strength as world reserve currency. Overall market FUD, fear, uncertainty, and doubt, right? So the first thing that we have to understand when we're trading this currency pair, before you can even understand the 2008 financial crisis and the downside impact that occurred from that, because you could be saying, okay, Jeev, why did we have this aggressive downside move from this price point of interest? Well, when we're trading the currency cross and pair, GBPUSD, we have to understand that within this pair, we have one of these currencies is a risk currency. The other one of these currencies is considered more of a safe haven currency and is known as the world reserve currency. So during times of economic uncertainty or doubt, or during any periods of times where you're having more dollar strength, which could be induced by the Federal Reserve central banking and interest rate hikes and so forth, you're gonna have the US dollar always dominate, even if the other currency can have some short-term strength. Because in this global financial system that we trade, whether you like it or not, the rules of the game are already set. The US dollar is the world reserve currency. What does this mean? This means that the majority of international business is denominated in US dollars. We can see this very relevant when you're looking at the oil industry and how oil is constantly exchanged in US dollars and is known as the petrodollar. So US dollar always dominates regardless of what currency pair it's in, unless you have something individually fundamentally impacting the other currency that can overpower dollar domination. But from a macro standpoint and a higher time frame standpoint, dollar dominates for that fundamental reason. World reserve currency, global business currency, petrodollar, safe haven globally still as well, right? Where for GBP, it's a part of your basket of risk currencies, just primarily linked to UK economy. No global business is denominated in British pounds, and more just linked to UK economy, politics, central banking, and so forth. Okay? So what I'm trying to say is the dollar holds way more weight on a global scale for these reasons stated. So what we have to understand is anytime you're having a fundamental catalyst that's going to be impacting on a global scale, dollar sentiment will dominate. And I'll show you how that's very prominent when we come to the 2020 to the 2022 period. But first, we're going to have a history lesson. Okay? So, now that we understand the US dollar is the world business currency, petrodollar safe haven, and GBP is more of your part of your basket of risk currencies, no global business denomination, and more just linked to the UK economy, politics, and central banking, we can have a better understanding of what's going on whenever that dollar domination is evident. So, 2008 global financial crisis. Risk currencies weaken. Dollar still holds strength post-crisis. Fear globally, right? So what we saw take place, what's going on here with I got it now. So what we saw take place is this excessive downside move. Sellers print this very significant low, and then for a period of years after the economic crisis, you can see we have a bit of a corrective phase and pullback that occurs for almost the 5 years, meaning we fail to break these significant lows, but also create a very strong sell side liquidity zone in this price sensitivity area, right? So we have huge seller impulsive move on a macro perspective due to the information advantage shifting on the higher time frame of a fundamental catalyst coming into play, being the global financial crisis of 2008, which was primarily from the US markets and had a ripple effect into global economies because of dollar being the global business currency. Huge devaluation and less demand in your risk currencies. Stock markets drop at that time. More fear globally, right? Then you can see you essentially have this pullback from around 1.45 to 1.65, where you're consolidating in this period for years before having another fundamental catalyst come into play that drives us down to these lows and potentially even lower in this overall bearish market structure with dollar domination. So here in the 2015 period, after failing to break this very significant seller supply and liquidity zone, we come up to this area, collect a lot more sell side orders, revisit these lows, and also break lower into lower lows. This being an individual fundamental impacting factor that brought negativity to GBP, being the first introduction of Brexit. Well, the first introduction was in the 90s, but the most recent. right? Then you can see, as we had an extended sell side move into historical lower lows printed here, we've had something very similar occur. You can see we're starting to create a very strong demand zone here on the higher time frames, as well as respecting the previous lows to the left here as a very key seller supply zone. We have already come to retest this supply zone twice now and failed to break, with this being the fundamental catalyst of the pandemic here. This was the pandemic move here. And don't worry, I'm going to explain everything again, right? The pandemic was enough volume and volatility at that time with initial dollar strength until we had dollar strength fade out, which I'll explain very carefully to all of you. So when the pandemic first came into scene, years after we had Brexit take place in the March 2020 period, initially we had US dollar gain strength. Why, when the pandemic first came to the scene, the US dollar gained strength? Well, remember, the US dollar is your global reserve business currency and a global safe haven. When you initially have that fear, uncertainty, and doubt coming into the market, you're going to have US dollar first pick up strength, but then we had the dollar turn bearish for about a 2-year period because of central banking action. First, I want all of us to understand this macro analysis. Then I'm going to dive deeper into breaking down what happened in the 2020 to 2022 period that we are in now. But what I want everybody to understand is the sequence of events here ever since the 2008 GFC is very, very similar, where you have a financial crisis or some type of global fundamental catalyst that has price drive even lower, breaking below very key price sensitivity areas, and continuing this macro market trend. Where this move was the global financial crisis. As the global financial crisis was priced in, we created that demand zone. We potentially ranged for a period of years. This is obviously huge moves on the intraday time frames, but on the higher time frames, you're technically seeing this range. But what's very important is you never corrected the GFC move. You never broke this higher time frame supply zone as well. Then here, you had Brexit come into play. Right? Brexit drives us into lower lows after a very strong bearish downside move there. And as Brexit begins to become priced in, you can see after that aggressive downside move, we start to consolidate for an extended period of years. Still overall very large intraday moves, but on the higher time frame here, having this consolidation phase. Where now, in my opinion, what we're starting to see occur here is more global economic recession scares, huge inflation risks, too much money printed, inflation risks, recession scares, rate hikes by Fed. I know I butchered recession there. Now, I'm gonna dissect everything that happened from the pandemic onward even better here, but I want everybody to understand what's going on. I'm going to dissect this even better, okay? But I want everybody to understand what's going on. We have another potential catalyst of entering a recessionary phase as economic inflation is extremely high because central banks went overboard when they had low interest rates and money pumping into the markets as they printed it out exponentially. And we have the potential for this historical repetition where I at least see GBPUSD revisiting these low points and filling the range and potentially continuing even lower, as what I see in the higher time frames is way more dollar strength. Now you could bring to the table, hey Jeev, I know the Federal Reserve is starting to raise interest rates, but we also have the Bank of England raising interest rates. Wouldn't this make GBP more bullish as well? Isn't hiking of rates bullish for the British pound too if the Bank of England does it? Yes, it is, but not against the US dollar. When you have both the Feds raising rates and the Bank of England raising rates, because the dollar is your global business currency, your world reserve currency, dollar domination takes over. That's why for the last period of months and almost a year, GBPUSD has been so extremely bearish, like these previous times highlighted before, as we've had the Feds shifting into an aggressive rate hike cycle at a very key interesting price point of interest. Right? So every time we've had one of these major fundamental catalysts, whether it is GFC, whether it is Brexit, whether it is this potential recessionary economic crisis phase coming up, none of those moves have ever been corrected again. We've just been respecting that broad bearish market structure since on a macro perspective. And what we are seeing in terms of market phases is we aren't seeing the large bearish impulsive move just yet. Right now, oh, sorry about that flashbang, everybody. Right now, we are in this very similar historical repetition like the post-2008 crisis period, where this fundamental catalyst can be potentially driving us down to these lows and even lower on the higher time frames here. But I at least expect us to be filling this range to the downside to revisit these previous lows when we understand the aggressive rate hike cycle coming up by the Feds, and of course the dollar domination, the bearish market structure, the historical repetition, and the bearish price action at play. So now, I also want you guys to notice something when I'm going to highlight the charts here. This is your dollar chart. Actually, we'll just look at the dollar chart. Now, look at GU here, right? Just to give you guys further validation of how much dollar dominates and how important the dollar strength is, of course, when you're looking at a global scale, okay? Rages, I don't got time for that. You've been watching me for years. You're too retarded for this shit. You know, keep watching my streams and shit. I appreciate the view, but if shit's not clicking after this many years of watching me, maybe you should fucking check out something else, my guy. Focus on what's at hand right now, all right? Sorry, needed one quick roast for the YouTube hyenas. Okay? When you're looking at GBPUSD here, you can see very large impulsive downside moves, minor pullback, large impulsive downside move, as we, of course, correlated there, minor pullback and potentials to continue down. Just to keep it very simple for visual referencing purposes, right? Downside, pullback, downside, pullback, downside. When you look at the dollar, right? From here, you can see we have more of the inverse compared to this situation here. All right? What you have to understand with the dollar is we've had a lot more upside here Then a consolidation zone created with dollar having a lot of potential for trading above this zone, going to previous historical high points into the 120s. And we're gonna explain this now in even more detail. Now, we're gonna be breaking down what dollar did from 2020 all the way to now. So we can clearly see very key price points of interest. Already explained multiple times in central banking webinars, dollar breakdowns, and so forth. When the pandemic first happened, March 2020, dollar initially spiked to the upside to this very, very key price point of interest and failed to break. This is before any central banking intervention. Okay? Before Feds took action. Okay? Now, the reason why dollar spiked up at the initial start of the pandemic is because before the Federal Reserve took any action, you had global fear, uncertainty, and doubt. Lockdowns starting to occur, people panicking, mainstream media causing mass propaganda and fear. The market sentiment was fear, uncertainty, and doubt. This would bring demand into the dollar in the short term as you're having the stock markets crash and institutions liquidating out of your global equities. But as we reach this very key institutional price point of interest and very key previous historical highs, this is when the Fed started to take action to support the economy. Then we started to see this huge devaluation on the dollar. I'll mark that in red. This is because in the period of March 2020, I've also explained this in the gold webinar. This is when the Feds, I'm going to label it in red here, cut rates down to zero and kept rates down, increased money supply, started their asset purchase program, which someone asked the definition of the asset purchase program. Why don't you read the fucking name? Asset purchase program. Asset purchase. Let's do it backwards. A program of purchasing assets. It's not fucking that complicated. You know what I mean? I've explained it in more detail in so many other webinars as well. It's as the name states. It's not fucking rocket science. It's fucking people are just retarded out here. Okay? The name says it. Asset purchase program. You read it backwards, it explains it even better. A program by the Federal Reserves to purchase assets. Right? That's what it is. AKA pumping markets. Okay? So the Federal Reserve at this time, March 2020, so you can see, like I explained in the gold webinar, March 2020, this is a United States money supply chart, right? This is when the Federal Reserve, during the pandemic period, exponentially increased the US money supply. So they can take that $18 trillion of printed, increased magical money, and they can pump the markets through their asset purchase program. Equities being an asset. Commodities, real estate, land, so forth, buying up assets to support the economy, right? But what takes place here is when you have this exponential increase in money supply, what happens to the US dollar value? If you're looking at basic macroeconomics and you have, let's just say you have a product, right? And that product has a very high supply. Let's say you're selling soccer balls and you have a huge supply of soccer balls in your warehouse and you're selling them for $5 a piece, but there's no demand for soccer balls. Everybody's playing tennis in this city that you're trying to sell soccer balls. What are you gonna have to do to sell more soccer balls if you have a huge supply of it, no demand for it, and your price point is at $5? Well, naturally, the price is going to be devalued down for you to get rid of the supply of the soccer balls, right? So when you have the Federal Reserve exponentially increase the supply of the US dollar and print out, it's just a magic button on a screen, they increase the money supply by $18 trillion. What you also have is, because of their asset purchase program, they're also removing the demand out of the dollar. The Fed and central banks are coming in during this time of crisis and saying, hey, we just have all this money now. We are going to pretty much pump up the markets. We're going to pump up the stock market from the crash point. We're going to be buying up commodities, other assets, mortgage-backed securities, bonds, and so forth. So the demand, where the customer for this demand is investors, smart money, the institutions, there's no more demand to be buying into the dollar because they're going to go ride the wave of buying into the stock market, buying into real estate, buying commodities, and riding the wave in support of the Federal Reserve. The cartel of the currency, the people who pretty much dictate and control the currency, just pretty much to keep it as simple as possible, say this: hey, the market's crashing right now. We just magically printed more money. We're going to take that money and we're going to pump up the stock market, housing market, commodities, and so forth. That's basically, to dumb it down as much as I can, what the Federal Reserve did. What they tell the mainstream media and masses is, oh, we're trying to help the economy. We're trying to help the working class people. The working class people got a $2 trillion in stimulus, $600 checks, while another $16 trillion went into the markets to make the rich even richer, right? So what you have happen to the US dollar is a huge increase in supply of the circulation of US dollars within the economy. The Federal Reserve take those US dollars and start buying assets with it: real estate, mortgage-backed securities, commodities, equity, stock market pumping, and so forth. And what that does is also remove the demand out of the dollar. So what happened for about that yearly period from 2020 crash to 2021 there was you had a devaluation of the US dollar because of lower interest rates, less demand in the dollar, exponential increase in money supply, and all the demand was in the stock market. The same time the dollar was being devalued, the stock market had a full recovery. Oil had a full recovery from minus $40 a barrel. Housing and real estate went through the roof. Inflation in CPI, cost of goods for consumers, went through the roof because a direct increase of money supply is going to increase economic inflation. But economic inflation works two ways. To a certain degree, inflation is beneficial for the rich. Inflation sucks for us, the working class. But the simple definition of inflation is that it inflates the price of everything within an economy. All the way from your small basket of goods, like your eggs and bread and milk that you buy for your daily living, all the way up to the cost of real estate, the cost of the stock market, asset classes, commodities, and so forth. So to a certain degree, the reason why the feds and government didn't do anything about inflation over the last 2 years is because, to a degree, inflation was benefiting them. You have to understand, for the 99% of people, the masses, the working class, every time they get a paycheck or any free cash, their primary spending is in consumption. Their cost of living, their rent, paying all their subscriptions, buying their food, paying their bills. Their money goes into consumption. So when inflation rises the price of everything, their consumption costs more. It's a negative effect to them. The same time the buying power of the dollar drops at that period of time. Right? But for the ultra rich and elite, the ones who rule the world, any free cash they have, their money goes into investment, ownership of assets, homes, stock market investments, business, land, commodities. So when inflation comes in and is inflating the price of everything, their wealth increases. Their real estate goes up. Their commodities holdings go up. Their stock market portfolio goes up. Right? So the reason why the government and central banks now are playing this game of, oh man, inflation is out of control. We don't know what happened. We didn't know. We should have been controlling this a lot sooner. It's just a game to tell the masses. It's nothing but a mirage. It's an illusion. This was all very surgical moves that at March 2020, the same time the stock market crashed and hit record lows, and you had the short circuit breaker hit on the stock market and no more short selling allowed. The Federal Reserve increased money supply and started pumping the markets. As COVID is going on and the stock market's going up, real estate market's going up, commodities are going up, who's benefiting off of that? Who's benefiting off of that? And the same time the stock market was going up, real estate's going up, commodities is going up, everybody else is locked down. The masses are losing their jobs, losing their businesses, paying more for the cost of goods. Right? So these are cycles that repeat through history, crises that occur, that are man-made to benefit the few at the expense of the masses. Okay? So let's go back to what we were talking about here. During the pandemic crash, the Fed started taking action March 2020. They exponentially increased the money supply. This leads to a devaluation of the dollar. Less demand in the dollar, more supply. Dollar for that yearly period at that time goes from like 101 all the way down to these historical lows at around 88.9. And what do you see during this exact period of March 2020? Check the date at the bottom of your screen there with GBPUSD. March 2020. It's the inverse. You come down to this historical low, have a large bullish rally all the way to the same high point before fading it out and having this downside move. Does that make sense to everybody? So you can see what we're trying to confirm is dollar strength dominates, or dollar movement overall dominates. Now, when we're looking at dollar now, you can see after we had almost a year and a half, 2 years of gains in the stock market, inflation go through the roof, stock market hit new all-time highs, North American real estate go through the roof, the gap between the wealthy and the middle class grow even wider, the rich get even richer. We hit this very key historical low price point of interest here, where we started to get a shift in the Fed policy statement. Feds talk about tapering. What's tapering? Stopping the asset purchase program. Feds talk about rate hikes. What's rate hikes do? What's rate hikes do? Bring more strength back to the US dollar, and to help combat in the increasing inflation, Feds raise rates. So now look at this. The same time after that year and a half where we had a huge rally in stock market, oil, housing, the same time over that 2 years you had that huge extended rally in oil, housing, stocks, and those asset classes, dollar comes to these very key historical lows, and the Feds at this very key price point of interest start to shift their policy stance. Now we're seeing a much more hawkish Federal Reserve with more rate hikes to potentially come as well. The reason for this excessive upside move on the dollar from mid-2021 to current day is all of these reasons, right? So, look, the same time you had this rejection from a high, the US Federal Reserve keep interest rates low, increase money supply, pump the stock market, downside move. Then they start tapering the asset purchase program, talk about rate hikes, actually start raising the rates, and we have a full correction of that move because we just had that equal action taking place. Instead of the asset purchase program, we're having tapering. Instead of keeping interest rates at zero, we're starting to talk about raising rates. Then actually raising the rates. Now bringing the rates back to a normal 2.5 to 3% range. Now, inflation is still high and the Feds are still going to be raising rates more. The same time we can potentially see global economies entering a recessionary phase. If we see, give or take, a minor pullback, right? And we start to break above this very key price sensitivity area of interest on the higher time frame, when we're looking at overall dollar movement that's starting to occur here, we have a lot of potential for dollar to be trending back up into the 120s on the higher time frame, right? With that being said, when you bring that correlation of understanding the Federal Reserve impact on the US dollar back to GBPUSD, you can see the inverse. Instead of having us come to that same low point and then having a bullish rally back to the highs and potentially continuing higher based on more rate hikes to come, based on combating inflation, based on the demand coming back into the dollar and equity markets having that bearish market cycle, GBPUSD is the inverse. From these lows, we came up to this very key sell side supply zone and having this bearish downside move that can still easily be filling the range to revisit these lows and potentially even lower. Right? Is everybody following along? A quick little update in the chat before I continue on. Don't remember, any of these major catalysts that impacted GBP or the US dollar there, they've never been corrected again. You've never had these corrections take place again. Right? So now, let's zoom in even more. Let's look at this piece of market structure and compare to the dollar of what we can still expect. Because remember, we're still on the monthly time frame. We want to bring this information down to our intraday levels so we can take some nice swing trades, intraday trades, even continue to scalp this bias. Even when you're looking at the repetition that occurs within this range, very similar in inverse of the dollar. Right? Where on the higher time frames, even if we were to get deeper pullback plays or just continue to break, where even the phase we are looking at is very similar here, we still have a lot of potential on the higher time frames, give or take a minor pullback that can occur or just driving down straight lower to come back down to these historical lows at 1.19. Holy shit, Crypto King in the chat. Crypto King, you owe me money. Sorry everybody, quick side note. Tell Crypto King in the chat he owes me money. We had a bet that he said Bitcoin was going to go to 100K by 2022. And I said Bitcoin was going to go back down to 30 or 15K. The video is on my channel. You can see Crypto King commenting on it and in the live chat at the time. You owe me money. Go back 7 months ago to my channel. This guy owes me money. Everybody tell him to pay up. He had a bet. He owes me money. He said Bitcoin 100K. He said I was dumb. He said I was stupid. He said I don't know what I was talking about. So he owes me money. All right. Anyways, back to focus. Does this also make sense to everybody too? About the repetition here, fundamentally and technically, when dollar strength is in the table. Dollar strength, dollar strength. And this was also 2016 USD strength. Right? Sorry guys, sorry for the distraction. Let's go back to focus right now. Okay? Does this also make sense? The very similar sequence of events that we can also take place. The same time fundamentally, we have expectations of more dollar strength because of more rate hikes to come to normalize back to 3%, global inflation through the roof, economic recession risk starting to develop that would keep the dollar still a bit more bullish as a global business currency and reserve currency. Now, if it was only the US that was entering some type of economic recession, that'd be a different story. But when you have major global economies potentially entering a recession, dollar will still hold some weight as a global business currency and as the reserve currency. Okay? Does this make sense to everybody? I still see us on the higher time frame coming down to 1.2 flat. And then when you come and look at the dollar here, it's just the inverse, right? These were periods of dollar strength here. Now, if we see dollar, give or take a minor pullback for this new monthly period, trading above 104 and continuing a lot more bullish, we have easy confirmations of expecting GBPUSD to drive down to these same historical lows, still respecting higher time frame bearish market structure, still respecting these sell side liquidity zones with very similar technical repetition we saw from the 2018 period here. Very similar overall structure that was created there as well. Right? Now, let's dive even deeper. So, you can see GBPUSD, now we're on the weekly. Ever since we hit that price point of interest at 1.4, this is what was significant. Double top in this key higher time frame price sensitivity area. Okay, so the reason why, as we came to that historical price point of interest, we started to see this technical double top occur, which shows us more buyers exiting and liquidating out of the market, as well as more sell side liquidity being generated that was based on a fundamental catalyst and information advantage of the Federal Reserve shifting their policy sentiment. What is the shifting of the policy sentiment? Tapering asset purchase program, aka slowing down APP. Talking about rate hikes and giving those signals. Rate hike plans, actual rate hikes. This was the reason why we started to get this exhaustion and buyers liquidating out from that very key price point of interest, more sell side liquidity generated, and ever since then been in bearish market structure. From that point, we have had sellers print these consecutive lower lows, have only had very short-lived pullback phases, with overall moves to the downside, because from a macro institutional perspective, what's primarily driving the price of GBPUSD pair down is dollar strength, which dollar strength is because of these reasons here. Right? We already did a gold higher time frame webinar, which is still active. Gold is still active. So the only way I would see dollar turning bearish is if the Fed start to reverse their rate hike cycle and go back into stimulus mode, which again would take away demand out of the dollar, or if you have a fundamental event that only impacts the US economy. Meaning, if somehow, let's just say monkeypox leads to only a US lockdown, or the US has some type of economic collapse. But the thing is, what's the word? It is very rare to have situations that will only impact the US economy because the US dollar is the global business currency. Does that make sense to everybody? Right? The US dollar is so integrated into global markets, from global import and export, global oil, global business, corporate to corporate, business to business transactions. The majority of this is just a ballpark. 80 to 90% is probably denominated in US dollars, then converted back to a country's currency for whatever use. Does that make sense to everybody? So if there was to be a catalyst that was going to impact the US economy specifically and have a drastic impact on the US dollar, it would naturally have a major ripple effect on global economies because the dollar is a global business currency and holds that power as the world reserve currency. Does that make sense to everybody? So, this makes sense to everybody, why we had this exhaustion. I'm just going to clear that out. And don't forget where it took place. Now, if you're looking at this sell side bearish market structure, you could see we had huge pullbacks that occurred as sellers were consistently printing these lower lows. But from a macro perspective, yes, you can play those pullbacks accordingly. But as we zoom into our intraday timeframes, 9 out of 10 times, if dollar's still holding that strength on a macro perspective, which now it is because of the more aggressive rate hikes to come, even though it could be short-term bearish, creating these pullback phases still get faded out as we have us driving down to these historical low price points of interest. I personally see that as long as the Feds keep signaling at more rate hikes, keep increasing rates up to a normalized 2.5 to 3%, that if we don't break this broad higher time frame structure here, that give or take some minor pullbacks, overall GBPUSD should still be driving down on the higher time frame to 1.2, 1.8 previous historical lows, playing that higher time frame bear structure, US dollar domination induced by the aggressive Fed rate hike cycle. So now we understand the higher time frames make sense. Why the dollar so bullish makes sense to us. Why GBPUSD is so bearish on monthly and daily makes sense to us. This technical repetition we're seeing on the weekly and very key reactions at very similar price points of interest, it makes sense to us. It's not random. We're not coming up here randomly. This is where liquidity is on a macro perspective. Now, let's take that information and start dissecting more into the lower time frames to map out trade ideas that we can see occur. So let's go down to the 4-hour chart. This is that very macro bearish market structure. In reality, you can see that a lot of the downside impulsive moves before we had excessive dollar strength come into the table, a lot of these downside aggressive impulsive moves that would print lower lows would almost show us an equal pullback that would still not break the overall market structure before continuing lower. Then, for those of you who don't know, from April 22nd, what's very important about this date is we had an IMF meeting, International Monetary Fund meeting, with all the major central banks came as a collective. Hawkish CBs. During this April 22nd, don't quote me on it, might be April 24th. Give me that 2-day little break there. But from April 22nd to April 24th, the International Monetary Fund held a global meeting with all the major central bankers there. Euro Central Bank, Bank of England, Bank of Canada, Federal Reserve. The majority of major players started talking about more aggressive rate hikes to come. The Bank of England, the Federal Reserve, the Euro Central Bank even started talking about coming out of negative rate hike territory. These rumors of more rate hikes to come had the market already adjusting and pricing it in accordingly, which led to this excessive downside move here, which was primarily dollar strength. You're going to see the same period in time around April 22nd, you had a huge burst in the dollar here, right? This was the market pricing in the more aggressive rate hikes to come, because this was 1 month prior to the next interest rate decision day, which was like May 5th. This was the last Fed interest rate decision day there, where we had a pullback and more buy orders extend up higher. The reason dollar was so bullish here was rumors of rate hikes to come, then more aggressive hawkish tone with their last FOMC. Right now, when we're looking at the dollar, all we've been simply seeing occur is nothing but a short-term pullback phase. Where I'm first watching reactions of this pullback phase to potentially see buyers jumping back in the market is these previous highs. When I'm looking at the dollar, if we double bottom here at 101 previous highs and fail to break, that double bottom signals to me more buy side orders being generated from a liquidity zone and potential for dollar to continue its upside move to these highs. Every time we've had buyers print higher highs on the dollar, you have some type of corrective phase occur. Whether that corrective phase is a pullback or consolidation zone. Here you had a bit of a consolidation zone, still a pullback. Here you get a pullback. Here you get a minor pullback, you get the idea. But what's important is any of these downside moves that we've seen occur on the dollar have always come from either a previous high or a new high printed by buyers. What that shows me is every time we have these intraday highs printed, we have buyers liquidating positions at a sell side liquidity zone after making favorable profit on these extended upside moves. And then as the buyers liquidate positions, this creates a short-term pullback phase as sell side liquidity gets collected to have them relieved out of the market, buyers exit out, sellers jump in hand to provide that exit liquidity. This creates these short-lived pullback phases. This pullback phase we've seen on the dollar from these highs, it may seem a lot bigger compared to any of these pullbacks highlighted in the red boxes, but you have to understand something. This pullback is in relation to this large impulsive rally we had. All of these pullbacks have been in relation to the larger rallies you've had. Does that make sense to everybody? So what I want us to do on the intraday time frames is, yes, we've had this short-term dollar pullback, but even if dollar was to break below 101, I would still just see it coming down to 99 before having more upside moves at this liquidity zone to the left. And what I want us to understand is, as manual retail traders who day trade and scalp, we have to play these waves accordingly. Meaning, when we see the higher time frame buyers come back into scene on the dollar, we know that that dollar domination is going to mean Euro USD sells, GBP USD sells. But even though we're on a higher time frame bullish on dollar, very easy to see dollar has been going up. We are day traders who intraday trade and scalp. Whenever the dollar is in a corrective phase, these corrective phases being pullbacks or consolidation zones, we can't be looking to play dollar buys. We have to adapt accordingly. And you can see that correlation active. Ever since here, which is pretty much almost towards the end of May there, mid-May all the way to current period, as dollar has been in that pullback corrective structure, with buyers taking profit from the highs, having a corrective phase for that new monthly period, what do you think you're going to see on GBPUSD from the lows? Right? But now we can see something very interesting. As dollar has almost near to retesting previous high price points to the left here, with the last previous highs being roughly around 101, you can see we're starting to get our first signs of potential seller exhaustion and dollar buyers jumping back into the scene. If dollar is trading back above 102.5 and doesn't break these intraday lows and maintains the bullish structure, which is based on an information advantage, if this doesn't change anytime soon, the higher probability is dollar's going to continue the bullish trend to at least revisit these previous highs printed by buyers. If we see dollar failing to break 101, trading above 102.5, what the fuck do you think you're going to see on GU? GU failed to break this sell side liquidity zone, which from these lows printed by sellers, you had pullbacks here, more sell side orders generated that led into these lower lows. The same time from that May 16th period, when dollar started to enter a pullback phase, we identified that pullback and we're playing it accordingly, as we were expecting us to revisit these sell side price points of interest. If GBPUSD fails to trade back above 1.265 and starts trading below 1.25, and we see dollar strength, where do you think GU is going to be going to? Right? So fundamentally, let me clean this up again. we will be filling the range to revisit these lows. Because we're still bearish higher time frame. We're still having sellers print lower lows and only having short-term pullback phases. We still have dollar domination as the world reserve currency and business currency. The same time we're starting to see dollar buyers come to the scene at this very key sell side liquidity zone. We have a lot of potential to revisit these lows. And look, it's not like we haven't seen this before. Look at this situation. Sellers printed significant lower lows, right? From these lower lows, you have an extended pullback phase occur. This pullback phase almost comes to this previous sell side liquidity zone here to the left. From this sell side liquidity zone, you get hard rejections, multiple retests in this area, and if you don't break the overall bearish market structure, if we still have the Feds doing tapering, increasing interest rates, and normalizing back to that price point of interest, and we don't break that price sensitivity area, you overall drive down to those lows printed. You see that every time with these short-lived pullback phases, right? For us to be breaking above 265, we would need to see dollar trading below here. Because right now, the first area of interest I'm looking at to see dollar buyers come back into the scene is around here. Previous highs at around 101. We would need to see way more. Talking so much. Fucking retard mode right there by me. We would need to see way more weakness in the US dollar and trading below here, which I would expect even deeper pullback phases, and us playing dollar bears in the short term down to retest these better liquidity zones for more favorable demanded price points for the institutions to get in at better price points of interest, better demanded price points, right? Otherwise, my first buy area back on the dollar is if we don't break this previous high. If we don't break these lows here and we start trading back above the last FOMC price here at 102.5, is we're just going to continue this bullish trend. We can assess the pullback phase coming to an end, breaking above the double bottom leg, trading above the last FOMC price, going back up to 105. With dollar chugging back to 105, GU is going to go back down to these lows at 1.215. So now, bringing that together, everything together, even if we were to get deeper pullback phases to 269, sells I'd be looking for, higher time frame. Minor pullbacks, sells. Breaks below 245, sells. Breaks below 2415, would still be primarily looking for GBPUSD sells. Right? That is our main bias, playing higher time frame bear structure, higher time frame historical repetition, fundamentals of US dollar domination as the world reserve currency, fundamentals of the aggressive rate hike cycle by the Feds keeping dollar bullish, playing the intraday bearish market structure, potentially assessing this pullback phase coming to an end and showing a lot of exhaustion at this previous sell side liquidity zone, and these downside moves. I would only be looking for any further GU buys in the short term if we had technical breaks above 1.27. If we get any fundamental reasoning for short-term dollar weakness to continue, or any impulsive reason for GBP to have more strength, which usually just ends up getting faded out because of dollar strength, I could only see any further pullback buys above 1.27. I would need to be breaking above this sell side liquidity zone and breaking above that higher time frame bearish market structure, trading above 1.27269 key level here, which would show me a lot more potential for deeper pullbacks on the higher time frame. Because don't forget, if we can just reject here and start to make our way down, that would be easy. That would be cake. Very, very simple. But it's very normal when you're looking at GU, even when you're looking at this previous downside run from 2018 all the way down to these lows, that we could get these aggressive pullback phases that last multiple weeks. Here you have a pullback lasting weeks. Look at this pullback lasted 2 months before still continuing down. Right? So I would only see above 1.27 that we could possibly have deeper pullbacks on the higher time frame, which we would play that accordingly still. But until then, we're still playing our intraday bias here. Bing, 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 coming back to the table. Especially on the intraday, if dollar does not break below 100.8 previous highs and starts trading back above this price point of interest, which this was the last FOMC Fed interest rate day. Otherwise, if we break below 100.8 in the short term on GU and Euro USD, play dollar bears, but don't lose sight of this macro analysis, higher time frames I'm teaching you guys. Okay, everybody. So I don't want to make this too long. This was almost 1 hour long now. It can become very difficult for people to understand and watch, but this is always available to rewatch as you wish. I'm going to save and upload this, and I'm going to go enjoy my weekend a little bit. Hopefully you guys enjoy these webinars, educational webinars, bringing together fundamentals, technicals, higher time frames. We went from monthly, weekly, daily, 4 hour to 1 hour. And yeah, it can be a lot to take in, but the more you watch it, the more you're going to learn and stuff, right? So this is always going to be available to rewatch. I'll see all of you later.